Have you ever went to a steak restaurant that I'm going to talk about one here in town. It's going to set the setting here today from today's radio show. I went to a steakhouse here locally, and everybody was telling me, some people said, I don't know if you would like it or not. Other people said, oh, it's great and excellent. So you got different vibes and stuff. So we finally did it. And to be quite honest with you, spent a lot of money and walked away really disappointed. I mean, some of the stuff was okay, but in theory, I could have went to the Texas Roadhouse. That's one of the steakhouses I go to for an inexpensive steak and still get, I feel like, walking away with pretty good quality. Sometimes we get what we pay for, right? And, I overpaid and was disappointed, and I can go, and by comparison, I could have went and paid less. Well, there's times you pay less, it's better, and there's times that you pay more, it's better. And really and truly, it's really hard to say, not unless we have experienced it. Okay? And, experience is wisdom. Welcome to the Retirement Income Source, where it's always about investing for income the old-fashioned way. I'm Tim Sparks, and our show is sponsored by Sparks Financial Group, a financial firm right here in the heart of the Bluegrass, Lexington, Kentucky, and serving the Louisville and the Central Kentucky area, including Northern Kentucky. What we teach here on the show is based on my 20-year experience of what to do, and most importantly, what not to do, whether you're a pre-retiree who wants to get it right going into retirement, because it's some big decisions, or you're a retiree who wants your retirement to end well. We talk a lot about investing for income. Well, here's what I'm going to tell majority of you that are driving down the road or fixing to park, going to eat or whatever. You're leaving money on the table. By investing in market-based investments, you are leaving money on the table because there's two sets of return, and we're going to talk about what I mean by that today to some degree. But keep in mind, we all should be very diligent. You don't want to just crawl in the back seat of a taxi cab and let somebody just drive you around. What I'm saying here is a lot of times we stick our head in the sand and assuming the financial advice from the advisor, that's the one at the steering wheel, is giving us the right advice. And it could be. And to be quite honest with you, when the markets are actually positively moving upward, you're not really going to notice a lot of things that we even say here that eventually will plague your retirement plans. Why? Because we know, beyond a shadow of a doubt, 99% of the time, people, when they take withdrawals from their portfolio, about 60 to 70% of that is coming from their own principal. That's right. It's coming from their own principal. That's that balance that you have right now that you're hoping to get income from. And sometimes there's an illusion out there about total return, and we're going to talk about that. And that's the matter of fact, that is the name of today's show. Total return is what's on your statement each and every year. You probably see it. You probably know what I'm talking about. Maybe, this year to date, you may be up 3%. Last year, you probably made 23%. The year before, you made 18% and so forth. You know what I'm talking about. That is total return. If you look at a 3-year average or if you look at a 10-year average, those are total return. Those are what's advertised on your statement. I'm just trying to help you to understand how your money works by looking at your statement. But actually, you need to go in depth and go a little deeper than that whenever it comes to getting income, because it goes beyond that. When everybody's listening to the show probably knows what their total return is. But whenever I ask them another question, nobody really knows, and that is how much income from your interest and dividends are you getting? And guess what? Majority of the people don't really know. Well, if you're going into retirement, you kind of need to know that. Why? Because you're going to be taking withdrawals from your portfolio and really don't realize that there is a train wreck about ready to happen. Not now, May not happen for a while. But when you're spending principal, what you're doing is you're giving up shares. It's like a farmer that's slowly selling the acre by acre of his farm. He may start off 300 acres. 10 years from now, he only has 200 acres. And then, whether the markets go up, down, sideways, it doesn't matter. He still has less assets. And that also has something to do with the bottom line of your balance sheet. And so what we talk about is, why not be like the farmer that didn't sell those acreage, so to speak, which are assets and leverage. Why not just create income by actually raising crops on the farm? It's the same way you do when you're dealing with individual stocks or individual bonds. Most people don't invest that way. I know that because every time I see a portfolio, again, I keep saying the same thing over and over. 99% of the time, people are not investing in individual securities. They'll say, I've got stocks. They'll say, I've got bonds. But there is a distinction between mutual funds that have stocks in them and exchange-traded funds that have stocks in them or bonds in them. Either one, doesn't really matter. There is a huge distinction. What do I mean by that? Well, mutual funds, really, basically, all you're doing is you got a package of stocks, so to speak, or a basket of stocks, and it could be 500 companies, and you may be thinking, well, there's nothing wrong with that. No, there's not. But when it comes to income, there is a problem with that because you're not getting the income that you need to satisfy the withdrawal that's coming out of your money, and you're calling it income, your advisor's calling it income. But at the end of the day, it's a train wreck, and eventually it's going to convert into a very disappointing retirement where you're going to continue to decrease your spending into the future because you're spending your principal. When you spend your principal, you can't make that money back. And you can if you only had a down year of one year or 2 years. But keep in mind, you also have to be a student of market history. And the student of market history says the markets over a 35-year cycle is going to experience a downturn, typically lasts longer as far as recovery, which means zero returns, compared to a bull market, which means it's another, the markets are basically kind of going uphill all the way for, anywhere between 13 and 14 years on average. And so you have to know the difference in the math of that, especially when it comes to total return, if that's the choice you're choosing. And of course, I hate to tell you, most people are actually doing that now. The reason I bring up market history, because this is one of the steps that you have to learn whenever you're dealing with total return. You got to understand that even though the markets go up over time, there is times of the market that the market doesn't go up at all. Matter of fact, it's a recovery time frame that typically can average anywhere between 13 years, this is the lowest we've seen in a certain time frame, as long as 25 years like it was in the Great Depression. So think about it, between 13 and 25 years, you're going to experience zero returns. And by the way, you need not a zero on that balance sheet when you're taking income from that portfolio. That's a portfolio that's going to actually be a wreck into the future, and to the point where the person is going to actually maybe have to make some changes in their spending. And, it's no longer, eating steak or going out or going on vacation, all that. They're going to have to actually minimize their spending so that way they can give their portfolio time to recoup, because it will recoup, but it will take time. But when you're in retirement, I've never met anybody that likes to sacrifice time, but you will, because it's an emotion that most of us go through. And when the markets are down, we just don't feel good about spending our money. And we help people to understand that if you invest correctly, and you know what instruments actually do well, just as well in the down markets as they do in the up markets, then you'll be okay with spending your income. So again, if you want to learn more about market history, then y'all want to get a commission report in your hand. Talks about stock market history, the pockets of time going all the way back from 1899 till now, where there's been zero returns and then bull market returns. You got to understand that the market alternate bearish and bullish, and if you have a bear, and you will eventually run into a bear market, how are you going to get through retirement? And that commission report can be yours if you call 888-930-1080. Again, that number is 888-930-1080, and we'll mail it or email it, whichever you prefer. And that's really the most important topic starting off our show. And, and as we go in and progress throughout this show, I'm actually going to give you some real facts and figures, some stuff that I only touched on last week on the show. I'm going to actually go more in depth, and I'm going to pretend like I'm putting on another hat. Y'all know I love income. I believe income is the way to go in retirement. That's our philosophy. It's a philosophy that I can look in a mirror and feel good that I'm giving the right advice. And at the same time, I feel like that the client can walk away and at 10 years or 15 or 20 years down the road and appreciate that they made that choice. See, it's all about making sure that the person is, if they understand what they're doing, understand what they're getting, how it's getting, in the long run, it's going to pay off. And so, if you remember earlier, I was talking about the difference between a good steak and an average steak. Well, I paid more for an average steak, and I paid less for a good steak. And at the end of the day, there's times that you can get a discount for things and be better off, and there's times that you're better off pay a premium. Depends on, and of course, I was using the steakhouse as an analogy, but I'm going to segue into this going forward about the S&P 500 versus dividend stock investing. Now, I'm going to give you some actual returns some research that I have actually done for the sake of this show, just to make some points clear, because people want two things solved when they go into retirement. They want to be able to beat inflation, and they want to be able to get income, and they don't want that income to change. Well, hang around, because we're going to be talking about that in just a few minutes. If you want to know more about income first methods, then I want to tell you about my book. Came out about 3 months ago, Retirement Income Shift, and it talks about how to get more mileage out of your money and what we're going to be talking about going throughout this show. And that book can be yours if you call 888-930-1080. Again, that's 888-930-1080. And we'll mail this book out to you, or we'll mail it to you, or typically we overnight it. And you can get that book if you're one of the first 5 callers, free, no obligation, 888-930-1080. Again, we're going to be going, get ready, we're going to be talking about comparisons of total return versus total return with dividends, and with higher dividends, and what the consequences are of the two as we go forward. This is Tim Sparks. We'll be right back. Welcome back. You're dialed in to the Retirement Income Source of Tim Sparks. Our show is sponsored by Sparks Financial Group, right here in the heart of the Bluegrass, Lexington, Kentucky. Also serving Louisville and Central Kentucky and Northern Kentucky. Today we're talking about total return. Now, the reason I'm talking about total return is because the results are still different as far as distinctions when you're dealing with an S&P 500 index fund versus an S&P 500, what we call an Aristocrats. Both of these are calendar returns. And I've taken the last 25 years to actually talk about here on this show. And as you know, total return, as we talked about in the past, equals I plus G. And there's two ways, there's two components that you make a return on your money. Generally speaking, it's how all money earns money, practically. Now, there are some instruments out there that don't pay any income. Gold, heck, there's a lot of stocks that doesn't pay any dividends. So that, in other words, if you have any of those instruments in your portfolio, which I know most people do, then you're not getting any income whatsoever. You're not getting rewarded. No paychecks at all coming from that company. If you want a paycheck, you have to start selling shares to get it, whether the market's up or down. That's what I don't like about non-dividend paying stocks, especially if I can go the same direction as somebody else using an S&P 500 fund. Matter of fact, we were talking about earlier, cheaper sometimes is better than paying a premium. We get this all the time. People, they question fees when a financial advisor is making money. I've had this question come up quite a bit. Well, I've always seen fees as always an issue in the absence of value. Well, when you're dealing with an S&P 500 index fund, you can go to Vanguard and get this, or you can go to Fidelity and you can do this on your own. You just cut out the middleman, okay? And the reason why I use the S&P 500 is it's probably the best indicator of the actual stock market. Yeah, there's NASDAQ, there's Dow. The Dow is the oldest, but the Dow really, is kind of, gotten, it's more evolved into the S&P 500, and the biggest reason why I think so, and the reason why money managers uses the S&P 500 more of a good indicator, because it's 500 top companies in America, your large companies. The Dow only consists of 30 companies, and when it first started out, when they started tracking the Dow, well, at that time, how many companies existed in the early 1900s? Probably not as many as there are today. Heck, there's a whole lot more companies in the top 500. You got the S&P 500, the Russell 2000s, and so forth. I don't know exactly how many stocks there is to own in America. Man, there's always new ones coming aboard. But what I found whenever I ate a discount steak like Texas Roadhouse, and I'm probably doing some advertising for them, so what? Y'all probably may agree with me. If I want a discount steak, I'm going to go to Texas Roadhouse. I think they got one of the better ones here in Lexington, or practically anywhere I've ever been. If I want to spend big money on the steak and pay a premium, well, I'm kind of a Ruth Chris fan. And I also like Malone's here locally. Well, you're going to pay a premium for that, right? It's kind of more of the experience sometimes too. At the end of the day, the discount probably better. I just save money. Well, when it comes to the S&P index fund and try to save money, let me give you an outcome, basically. And this is my own research. And I actually used a spreadsheet, so there's no way of actually, people always say, just like Joe Friday, just the facts, just the facts. Well, this is the facts here. And what I'm going to do is I'm going to start the beginning of 2000 and end till today. And the reason I'm using 2000 in this analysis is because you got calendar returns. They're factual. This is the factual part of it that I meant. Going back in history, and I'm trying to make some points throughout the show. But whenever you go back in time, the markets were bearish and bullish in the last 25 years. It was primarily bullish in the 90s, right? And probably about a half of the 80s. But in what makes this more reasonable to me is because it had a bear and a bull in cycle. Actually, the bear cycle was still longer than the bull cycle. 2013 was bearish. Nobody made any money if you had a discounted, this is the discounted index fund. And not only that, if you took withdrawals, it's even worse. If you took out 5% between 2000 and 2013, that's $50,000 a year. During that bear market that I'm talking about, by the time you got to 2013, let me get my little spreadsheet right here, you're down to $343,000. Now imagine that. $343,000. I don't know about you, but that retirement is flat out ruined. I mean, and they'll never make that back. By the way, you're paying a discount to get this. This is like a really top fund, and that you're not paying any fee for. So this is, sometimes we pay for what we get, right? Well, conversely, if I have a dividend stock portfolio, and I'm just comparing this to the Aristocrats. 2013, taking out $50,000 a year, I have $1,689,000. Wow! In other words, I grew 60% cumulative return while taking out $50,000 a year, but yet I've got 5 times more of the money than I do in the S&P. And by the way, you could have got that at a discount as well. So you see, just comparing a higher dividend than growth with very lesser dividend is a significant difference in a bear market. And you see, it's not the bull markets that people need to be concerned about. They shouldn't be concerned at all. Heck, I wish the markets will always be bullish. But I'm not conning myself and making myself believe that the markets are always going to go to the moon. They're not. And I have to be prepared equally also, whenever the markets go down. And so since I started talking a little bit about market history between 2000 and 2013, before we get into the bull cycle, which is the next 11 years of this 2025, you're going to see a significant difference as far as the difference between the bull and the bear, but how the bull in the S&P discount fund does not make up the money that was lost. It's permanently lost. Where if I was in the dividend portfolio and I had lesser risk while in that dividend portfolio, my money continues to grow. And that's the significant difference between the two. I hate to be the bearer of bad news for a lot of people out there that are trying to either do things on their own. But there's a lot of things, just like I've learned over the years, I just didn't know what I didn't know. And I have learned that, and when I find out something to be true, I'm not even going to think twice. I'm ready to make my changes because that's just who I am. And in spite of what I thought I knew. So I like to get a commission report in your hand. Again, it's on understanding stock market history. Because see, when you're investing and you're in retirement and you're trying to get growth, well, you need to kind of understand that there's pockets of time that you don't get growth, and it's an eye opener, and you have to determine whether you want to continue staying in something that actually may actually hinder your retirement to the point where you're going to change your lifestyle drastically, and I have actually seen it with prior clients. And this commission report can be yours if you call 888-930-1080. Today we are talking about total return. Most common advice today, and it still hasn't changed. Matter of fact, most advisors are trained on how to give total return advice, which beware, because at the end of the day, all the information you read about is all about total return. I don't know about you, but it seems like there's always a new wrinkle in a positive way, putting a different spin on, trying to keep your money invested in the market, so that way you can, you can do very well in the market. And while you're, even though you know that the markets have times that the markets don't go up, but they don't say that. They don't say that whatsoever. So the advice today, again, is total return advice. Everybody's trying to out-clever each other on how you can outsmart the market. Well, I haven't found anybody actually do that, just like the weatherman can't tell you where the weather's going to be, and that's the same way is true whenever it comes to the stock market. Because think about it, you're going forward. Everybody looks back. Well, today we're going to be talking about an analysis on the discount index fund versus a discount fund an index fund that actually had higher dividends, but the results are astonishing. And keep in mind, people, whenever they're trying to beat inflation and get income, there is a significant difference of which one of those you should have owned, and also be prepared for the volatility at the same time, including a bear market. Most people would say 2008 was pretty dramatic to their portfolios. Well, if you were working, it didn't really matter. But if you're a retiree, it completely matters. Matter of fact, it's a retirement more than likely. If you stayed spending your money as the advice you were given, you're going to eventually wind up broke in about 15 to 17 years. I'm a very blunt person. I know sometimes people, it's hard to accept being blunt, but that's just the way I've always been. And so I like to get a book in your hand talking about income first methods. You can actually have stocks and have income first methods and get growth, but try to minimize spending of your principal to do that. That's a defensive income strategy while being in the stock market. And this book can be yours if you're one of the first 5 callers of today's retirement income source, 888-930-1080. Again, that's 888-930-1080. We'll mail it out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. Again, we're going to talk now, shift gears with the bull cycle of these 2 comparisons. When we come back, you're listening to the Retirement Income Source. This is Tim Sparks. You're tuned in to the Retirement Income Source. This is Tim Sparks. Our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky, serving Louisville and northern and central Kentucky. Today we are talking about total return. What is total return? Well, just to get into the weeds here a little bit, and it's extremely important, especially for people that are planning on going in retirement soon. If you're 5 years out from retirement, you really, really want to reach out and try to find out what this actually formula is and how it can make a difference, so that way you can hit the target date that you're hoping to get whenever you go into retirement, because that is extremely important for most people. And total return equals I plus G. That's dividends that are paid to you by certain companies that pay dividends. There's companies out there that pay no dividends. It's kind of like a landlord that owns a rental property. He knows that the I part equivalent is, in this scenario, that's what a dividend is to a stock, but also rent is to the house. It's the same analogy. They work very similar. But the thing is, though, when you combine the two, it creates some synergy. And whenever it comes to growth, there's pockets of time you don't get any growth. There's pockets of time you get exponential growth. In other words, you get double-digit growth. So if you take the average return from all the way from 1899 till now, it's probably, let's just say around 10%. It's probably more than 10 or 11%. But in the last 25 years, it's only been about 7.5%. But going back historically, it's been about 10 or 11%. So with that being said, and some people would believe it's still going to earn that. I don't know. I don't, we're talking about going forward. Nobody really knows. When it comes to your money, you really have to pay close attention, especially whenever you're taking income from it, and for retirement, because inflation still hasn't changed. It's actually still going up, and when it goes up, where it's now, everybody's noticing it. It affects everything you go out and buy. We already know that. I don't need to tell you that. But whenever you're in retirement, it is extremely important to be able to understand that inflation has such an impact, and it's really the hidden tax of retirement. But whenever you get dividends and growth, it's like a landlord that gets rent checks and the appreciation of the house. They know over time that the rent's more reliable. That's money in motion, day by day. That's why I like dividends and money in motion, day by day. But growth is not money in motion, day by day. You got to wait for it. You know, a little commercial on television. Wait for it. Wait for it. Well, that's exactly what stocks. That's what real estate. That's like any instrument. Yeah, you can get lucky. Every hog can find an acorn. We know that. But at the end of the day, capital appreciation takes time. If you want capital appreciation, you got to get dividends equivalent to the income that you need, just like a landlord gets the rent that they need. Now, obviously, they're not going to jack the rent up to just to keep from renting a property. They got to be within reason. But when it comes to dividends, actually, there's a lot of companies out there. I was just making a list of them the other day, and I'm going to give you the names of the companies because it would be construed as advice here on the radio show. But there's been companies that's paid dividends 50, 60, 70 years. Companies that's been around a long time, they still are paying dividends today. Well, did you know dividends keep increasing over time? You know, I asked our analysts, I said, what is the range typically? And it's anywhere between 0, because sometimes they don't increase at all, as high as 5% on a given year. And so I went online. I don't just take things, I take things like a grain of salt. I go online and I check it out. I'll go and I'll look at these companies, and sure enough, the dividend keeps increasing. Keep in mind, dividends are paid on a per share basis. That's the reason why we say even in down markets, the dividend is still paying. Why? Because you're still on the share. So that's what confuses people. But that's the reason why we tell everybody, you know, listen to this show, get educated, be intentional about this right here, because you may find that actually Warren Buffett was right. Dividend investments is a much smarter strategy for anybody. And yeah, that's what catapulted his wealth. When he owned all these companies for all these years. Why? Because they kept paying dividends, and it kept exponentially growing his wealth organically. And you know, there's times that you don't get any growth. That's fine. You're getting dividend, doesn't really matter. What's it matter? I mean, at the end of the day, people say, well, how long will the dividends pay? Well, as long as the company keeps paying you the dividends. And if what we do is we have analysts that actually selects these companies that pay dividend, and to make sure they're going to continue. That's why you pay somebody that's a specialist. Now you can pay a premium. You can go to Ruth Chris, or you can go to and pay a premium, or go to Malone's and pay a premium, and feel like that you're walking away with probably a better steak than it would be if I went to the Texas Roadhouse. I got a discount Texas Roadhouse, and I'm okay at Texas Roadhouse, but I paid a premium, and I walked away. It's the same way with the hotel. If I go to the Four Seasons Hotel, it's going to be a different experience than it is if I went to the local Holiday Inn. At the end of the day, we get what we pay for. And it's the same way is true when it comes to premium advice. Premium advice typically walks away better than the client that's trying to save money because they don't want to pay a fee. So with that being said, I want to get a commission report in your hand called Investing for Income While Being in the Stock Market. You got to know what you're doing. I know a lot of people can go out and find companies, but somebody that knows what they're doing can get actual growth and income from dividends. And not only that, there's times that companies will eventually cut their dividend. I've actually seen it just in the last 3 months. We had a company, they cut their dividend, and it's suicide for that company that you hold, because the company's going to start actually going down in value. Companies get too mature. Well, if you don't know that, you don't have any way of, you don't have the research on that. If you're doing lazy investing, you're going to tell your advisor go do it. Well, you may have saved a fee, but unfortunately it costs you a return at the same time, not just a dividend, but also the returns going down. So we get what we pay for sometimes. So again, that commission report can be yours if you call 888-930-1080. Again, it's 888-930-1080. We'll mail this or email it, whichever you prefer. Again, 888-930-1080. You're listening to the Retirement Income Source. This is Tim Sparks, and today we're talking about total return. the most common advice today, and I know that for the first 14 years since I've been in the business. That's the same advice I was given. And so I wanted to pretend like I'm wearing that hat, even though I was really, when I was creating the show today, and it was kind of disturbing because I said, I don't want to ever go back and give this kind of advice because I know what kind of train wreck it could be. But believe it or not, most advisors are still giving advice based on total return. They're relying on total return, which means the bulk of the return is coming from capital appreciation, because they think the crystal ball says the markets are going to go up. Well, that's only somewhat true, but not totally true. And so that's the reason I was talking about earlier, the commission report we were talking about, stock market history. You got to understand, stock market history historically has had patterns of zero growth that's averaged around 20 years, going all the way back from 1899 to now. And then there was double-digit growth that averaged anywhere between 12 and 14 years historically. And they went back and forth. It was like a pattern. It was not necessarily totally predictable, but it kind of made you feel that way. And so understanding market history can make a big difference. That's the reason why we try to educate the public on this through the radio show, because, at the end of the day, if you knew that there was a better opportunity out there that can actually get you dividend or get you maybe a better even total return, which is what you're trying to do. You're trying to get a total return on your money because you're wanting to beat inflation, keep up with the income and inflation, that adjusted income at the same time. That's not going to be very easy to do. And so, the advice today is just primarily using annuities and throwing some money inside of a great mutual fund portfolio that could be 5-star rating funds. But keep in mind, people, that if you take the guaranteed income from the annuity, that annuity will lose its buying power within 5 to 8 years. And I know you've probably seen the software. You were probably given a forecast of what it's going to look like 20 years from now. Well, I hate to give you the disappointing news. That's not reality. That's a hypothetical forecast. And a hypothetical forecast does not mean that's actually what it's going to look like. Now, if you want to feel good and give you a sense of security, or I call it a false sense of security, because in theory, because there's no way of nobody's going to know what the returns are going to be, because it hasn't happened yet. Now, we're all geniuses if I look back, but the thing is, though, you're wanting somebody to give you realistic advice going forward. How can you get income if the markets go down? Isn't that important? I mean, I want to kind of have income protected from a downturn more so than an upturn. I mean, anybody's going to do well, and it don't matter what you can go with the worst advisor, don't have no credentials, no nothing, and if the markets are going to do nothing but be like a tailwind at your back, you're going to pat them on the back and say, "Great job." They didn't do it. The markets they did it on their own. The markets did. The advisor never causes the markets go up. They never cause the markets to go down. But there's different advisors out there that use different tools just in case they do go down. What do? You got to plan worst case scenario and hope for the best, or at least that's how I think. I don't know. Maybe you think differently than I do. I don't know. But you don't want to go down the path of spending money thinking everything is great, so far so good, and then you get about 8 or 10 years down the road and you start noticing your balance is just not recuperating. And just like I was talking about earlier, the S&P index fund, no advisor at all been involved. You go to Vanguard and get this discount fund, you can probably it's probably about as good as any fund out there. And if you started the year 2000 till now on $1 million, taking out $50,000 a year with no inflation adjustments, which, by the way, you would have to in 24 years. You would have to increase your income, or you're going to quit buying the things you used to buy beginning in 2000 by the time you get to 2025. Why? Because things went up. As you know, inflation itself went up, over 25% just in the last 3 years. Everything went up. So you can't just spend a stagnate at $50,000 a year. So by the time you got to 2025, you got $392,000. Now, that's okay. If you call okay, it's mediocre to me when I'm looking at the numbers here, because I could have avoided that. I mean, don't get me wrong. I like an S&P index fund just like anything else. It could be a great tool for the right individual. But for somebody that's taking an enormous amount of money out, you better hope and pray that the markets are going to be going to the moon. That's the only way you can make that work. I've learned that I'm not trying to con myself. I want to do as much research because I'm trying to be earnest. I'm trying to be earnest for my family. So I don't want my family, I want to be there for them, for my wife as well. I mean, it's a big decision. And so people need to know the difference. And I'm going to give you the other outcome here right after we come back from the break. But if you want to know more about income first methods, I'm going to offer you my book here, free, Retirement Income Shift, How to Get the Most Mileage Out of Your Money. And this was Amazon bestseller in 6 different columns of personal finance. And this book can be yours again if you're one of the first 5 callers by calling 888-930-1080. Again, that's 888-930-1080. If you're one of the first 5 callers, free, no obligation book, Income First Methods that work in down markets as much as up markets. This is a great book, 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks. We'll be right back. Welcome back to the Retirement Income Source. This is Tim Sparks, your host. And this show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky, serving Lexington, Northern, and Central Kentucky. Today we're talking about total return. And really, I'm doing some comparisons here. And really, the foundation of investing, especially for people that are heading into retirement or already in retirement, and they need income of 4% or more, you want to pay attention to this show, because 4% from your portfolio, you need income from it. Most people that we meet with are taking anywhere between 4, 5, sometimes 6% of their account value each and every year. Well, I want something that can get me more mileage. Okay, and what do I mean? I need a dividend that can actually cover that withdrawal. The more I cover with that, common sense tells me my money is going to last longer because I'm not touching my principal. There's nothing wrong with touching your principal. You get about 12, 15 years down the road because you got less life, right? Most people's retirement plan are typically going to last anywhere between 15, 20, 25, or even 30 years or more. And so the key is that in order to get an inflation hedge, you can't spend principal. Principal is the only thing that can give you the hedge. And why? Because if the markets go down and eventually when they recover, you still have your principal intact. But if you're spending your principal, it's hard to recover it. And that's what people don't realize. So as earlier, I was talking about an S&P 500 index fund. If you take $1 million and spent 5% a year, no inflation adjustments at all, just $50,000 a year to 2025, you would have $392,000 left. And that balance at one time got down to $320,000. Now, for most of you out there, you said, I don't want all my money in the stock market. Well, I'm just trying to make a point, because there's a lot of people out there that, believe it or not, they got mutual funds and exchange traded funds, and they come in here with 80 to 90% in the stocks. So I'm talking about that because if they run up against a buzzsaw, and we have some down markets, and they're going to actually experience a downturn, and their balances go down, and they'll never be able to make it back up. because there's not one time that this account value got back to $1 million in that 25-year time frame. I've never met anybody that wants their portfolio to see it drop and just stay dropped. To me, it just feels like that I'm impoverished. And I've never, I mean, think about it for a moment. Who wants to have, the stress of an impoverished feeling? So if you want to know more about dividend investing, there's a technique to it. And actually, to be honest with you, majority of you, even when you read it, some of you may go out and try to do this on your own, but it's the reason why I decided to get an analyst. I'm not going to try to do it on my own. Yeah, I can get lucky and go out and find some companies, but at the end of the day, when I see the results of growth and dividends combined with the analyst and then compare it to my amateurness, there's no comparison. But it's a great commission report to kind of help you to understand, because the results I'm going to be talking about in a minute are totally different night and day of taking income from a portfolio that's focusing on income with much or a lot less risk than it is with the S&P 500. But this commission report can be yours if you call 888-930-1080. Again, that's 888-930-1080. And we will mail this or email it, whichever you prefer. Again, it's 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks. And today we're talking about total return. Total return is what most people's got accustomed to in their 401ks, their 403bs, their thrift savings plans, wherever you have your money invested in with your employer, and you primarily got it in mutual funds, which are actually more than likely probably selected for you to kind of give you a diversification. That's the reason why you see about 25 to 30 funds. And that's what we learned. And we just kind of put money away and took advantage of the match, and voila, 40 years later, you got a lot more money than you did day one when you started. And you should have, because the markets go up over time, and not only that, you're not taking income, so it really doesn't matter. You're not paying attention to the downturns, because the downturns actually rewarded you. But when you're in retirement, it's just the opposite. It's the most cannibalization of people's portfolio is whenever they take money out at a much reduced, when the share prices are cut in value. And so you want to make sure that you are prepared for that, for the downturn. And so with that being said, let's segue into the comparison. So I said the S&P 500 index fund pulling at 5%, 50,000 day one in beginning 2000. I'm involved in a bear market and a bull market here. A bull market on the tail end, the last 11 years, the first 13 years of bear market, $392,000 was the results. And most people say, well, that's okay. Well, if you adjust it for inflation, you would have probably run out of money by the time you got to 2023. Why? Because you needed more income because everything went up. Or you went to peanut butter when you started off eating steak. So if you were in a dividend, more like stock portfolio, one that has factual data, beginning of 2000 till now, the results is totally drastically different. Over $5 million. Now you may be sitting there thinking, that's unbelievable. Nah, I can show you the results. But I mean, I'm not going to give those results other than to tell you what the bottom line is here on the radio, and those are real information. There was time the S&P actually outperformed this instrument. Has nothing to do with it. It was lesser risk in the downturns is what made the drastic difference here. Plus the dividend typically is about 1% more. By the way, people, our clients are getting 4.5% dividends on average. And this portfolio that I just was talking about only was about a 2.25% dividend, where the S&P is only about 1.4%. Keep in mind, dividends are huge in down markets. And so that's the reason why we talk about investing for income, because you have your shares, you'll come back, you get more recovery. But total return for total return, the results are out. There's a huge significant difference. And if I'm trying to beat inflation, matter of fact, I could have continued to raise my income throughout that 25-year time frame and not been had one iota of being scared at all during that time frame, which all of us do. When the markets go down, we get very emotional. We don't want to take money out. But keep in mind, this is somebody sticking with their plan and taking out their income, and their portfolio just kept growing. And that's actual results. Just like Joe Friday just said, show me the facts, show me the facts. And so that's why I like dividend investing over growth investing. Nothing wrong with growth investing. You hear the word growth, you're thinking, dividend value. Well, dividend value have a tendency, and historically, to outperform growth because of the dividend. The dividend a lot of times is at least 3 times more than the S&P 500, and it makes a significant impact on the reinvesting and buying more shares. Think about it. You got a lazy investment there sitting there doing nothing, kind of like an abandoned property, and if you put dividends in it, kind of like a rental, getting rent, I'd rather get the rent and have my cake and eat it too. I'm going to get more. I'm going to get more money, more capacity out of that, so to speak, by just investing for dividend. Not only that, if the problem is income, you probably ought to really consider if dividends is the right for you. With that being said, we come up to the end of our show today, and I want to give you an opportunity to learn about income first methods by getting my book, Retirement Income Shift, How to Get the Most Mileage Out of Your Money. This was Amazon's bestseller for the last 3 months. Came out in October. And in 6 different categories of personal finance. And for the first 5 callers, free book, 888-930-1080. Again, that's 888-930-1080. And we'll mail this to you or email it, or no, can't email it, sorry about that. I do believe that there is an ebook on this right here, but my number is 888-930-1080. Again, discounts are okay. If you want to go to an inexpensive steakhouse, use what we kind of started with. Paying a premium is equally okay, probably more than likely better if you want to have a better result at the end of the road, especially whenever I use the competing indices that I just now covered over the last hour. We hope you enjoyed it, and I look forward to next week for some more great information. Thank you for listening.